Hello, everyone. Welcome back to another Startup Prize webinar. Hello, I am super excited today to have, oh, look at that. Cian, you're right up there. I'm going to add myself. Here we go. So today, super excited to have Cian Robinson here with us. We're going to be talking all about due diligence. But before we do that, I am taking this quick moment to thank our sponsors who are the reason that we are even here. So a big thank you to the Prize Foundation and Louisiana Economic Development who help us present Startup Prize with generous support from the Anderson family, Blue Cross and Blue Shield of Louisiana, Business First Bank, Caddo Management, uh, Caddo Parish Commission, Chaff and Associates, the City of Shreveport, Greater Bossier Economic Development Foundation, Hurd McElroy Investor LLC, Kallenberg Phillips Family Investments, Heidi and Gregory Kallenberg, North Louisiana Economic Partnership, and Oshner LSU Health Shreveport. Thank you so much. You are the fuel to our engine, and we couldn't do it without you. Cian, I'm not gonna waste a whole lot of time. I think we're just gonna jump right in. Do you want to maybe a very quick and dirty bio of kind of
Quick and dirty is emphasis on dirty part, probably.
I like that.
Right. So, Cian Robinson, the president and founder of Robinson Ventures. We're equal parts management consulting and venture capital company. We're based in South Carolina. And our investment thesis on the venture capital side is primarily within healthcare and higher ed, and specifically within the digital sections of that. So, and then a proud supporter of Startup Prize focused on health. I've been a mentor, judge, investor for 3 or 4 years now. So looking
Yes.
forward to this conversation with you.
I am super excited because I think we talk about it a lot, but we're going to try our best today to stay away from all the crazy acronyms and really keep it keep it as simple as possible. So I think just to cap it off, we're going to be talking about due diligence today. So I think the best thing to do is really maybe a little table setting to get us started.
All
So what is due diligence? And more specifically, maybe we could talk about due diligence in terms of early stage companies, maybe through that seed level, like right as you get into Series A. How about that? We just kind of break
Yeah,
it.
yeah, sure. So, at its heart, due diligence is research, is really the way you need to think about it. And so, it's when an investor is researching a company and to take them through I would call it their underwriting process, right? And
Hmm.
so they're going out and they're vetting and they're validating, and um, early on in the pre-seed and seed. Um, they're really vetting the founders and the problem that the founders are trying to solve, right? And maybe people are shocked that what about the solution? Well, sometimes that MVP isn't quite there yet. The MVP is yet to really be taken. MVP stands for minimally viable product and or service, given we want to avoid acronyms. But really, it's research, it's vetting, it's validating. It's founders, it's the company, it's the problem, the solution. And early stage, you're really looking at the founders and the problem. And then the info that comes from this due diligence research project comes from across the spectrum. So it's the company themselves that are opening up. Usually, what it is, it's a data room that they've created and collected all this information in. And then as a funder, we also have our own resources. So we use PitchBook or Crunchbase or other different, I mean, heck, right now with the different AI engines, I mean, there's some phenomenal research you can do just using a Gemini or a Chat GPT or something similar, right? Or some of the bigger ones. But really what we do is I have a couple of analysts and they get to work conducting the research.
I love it. So, okay, so we've kind of established due diligence. Let's talk about why it's important. And maybe we can look at it from the perspective of the investor, but also from the side of the founder. Why do this due diligence? What is the goal and why should you not maybe take it so lightly, right?
Okay, so due diligence is your best foot forward, period. Right? So let me just take this from at least once a day, we get an inbound message of somebody who wants funding from Robinson Ventures, right? And we're a small boutique family office. Our check sizes are tiny, like under 50 grand, right? And so when you actually get through the wall, which is, yes, we would like to talk to you, right?
Hmm.
Now it's time to put your best foot forward, and the due diligence process is part of that best foot forward. I've seen way too many times where companies come in and we bring them through the process, and we get into diligence, and man, the information isn't there like it should be. It's
Hmm.
missing, it's ham-handed. It's never a more embarrassing moment when you figured out you haven't done your homework. And so what I'd say to founders is go do your homework. Make sure that the due diligence that's being requested in this data room you put together is high and tight, right? And it's because all of that data, is used to underwrite the decision, right? And due diligence is not only one-sided, right? So what I would say to founders is you should evaluate your investors as deeply as they are evaluating you, right? Because sometimes it's not a fit. Sometimes there are, unfortunately, known investors out there that are aggressive, that'll conduct weeks of due diligence, and then 6 to 9 months later, suddenly a service comes out of their own firm that looks very familiar, right? Again, I come back around to do your homework. Make sure that you're not only chasing the dollars that you need, but the dollars that are smart and wanted from you as well.
I like that answer. I think you're right. That kind of work up front, that work early on also helps you not waste time like splatter painting, like trying to hit every single investor out there. It really lets you be focused. I know I promise everyone too, we're going to start talking about what that data room is. But before we start really kind of digging into that, um, what are investors really looking for in that due diligence process? And then how much maybe variation is there between, say, a family office or an angel group or VCs? I mean, there's a lot of different angles and kind of maybe what those expectations might be, or maybe different weights to things, I
Yeah,
guess.
so let's take the latter half first. What
Sure.
you're really talking about is the risk appetite and the risk profile of the funder, right? And so when you think angels or family offices, they're usually earlier on, right? So pre-seed, seed, maybe some Series A, right? And so they tend to have a much more, by nature, they're less risk averse, right? They are willing to take and roll the dice on a founder, a problem, and the solution that they're thinking through. Um, when you enter into the world of VC, you're moving from, and when I say family offices and angels, they're no less professional than VCs. VCs now all of a sudden are into this environment where they have not just the family office dollars and not just their own dollars, but they have limited partners as part of a fund that they've raised. And so now the thesis has moved into they are required to have a return, right? It's a nice to have. It is 100% a need to have that there's been agreement to multiples on invested capital, internal rates of return. It moves into a much more structured, I would say, financially driven calculus. Now, with the family office, are we doing that? Yes. As angels, we're doing that. Yes. Sometimes it's a little squishier, right? Which is we invest in the human, right? And we can be maybe a little bit more patient or a little bit more understanding. And so, what I would sit there and say, what we're looking for in due diligence, especially in early, as problem being solved, the solution that's being proposed, it doesn't have to be perfect. It can
Mhm.
be that, as we defined before, that minimally viable product or the MVP. I like to understand a founder's why, right? Why are you trying to solve this? And some of the best founders that I have invested in and run into, it is a hyper personal why. Somebody in their family got cancer, and then they're a telehealth or telemedicine or behavioral health specialist. And so now all of a sudden they want to provide, behavioral health telemedically to cancer patients, right? Understanding their why and their ability to articulate that connects emotionally and connects to the purpose of what this company is trying to do. Um, the size of the market's important. So when we're doing some due diligence, if the market, by the way, PS, I love when it's $1 billion marketplace, right? Okay,
Sure,
great.
yeah. They
Yeah,
all
yeah,
are. That's
sure, sure it is, right? And then you start to noodle it through, and then you're like, okay, your total addressable market may be $1 billion, and then your service addressable market gets even skinnier, and then your surface obtainable market becomes even skinnier, right? Coming out and saying, by the way, I'm going to gain 30% of a $5 billion marketplace within 2 to 3 years. Immediately, we're like, probably not. And then we also, at the end of the day, while VCs are more focused on this, I think because they have the responsibilities of their LPs, we are also looking for a return, right? We're not doing this otherwise, just let's call it charity and non-for-profit at that point in
yeah,
time, right?
yeah.
It really becomes we have to have a reasonable return.
Okay, so let's start talking about what this data room looks like, what type of information that's really important for you to be, if not at least providing, thinking about, and getting prepared to provide. Uh, Maybe starting in kind of the realm of your financials. What kind of documents, what type of financial information are you specifically looking for as you start kind of in this process?
So with financial, especially for early stage companies, they're more than likely going to be some projections, right? Because they don't necessarily have clients, they don't have revenue, they certainly do have costs. And so when we're looking at the financials, we're looking for mostly pro forma financial statements that they've developed. Do they have or have they have a thesis around, have they developed a test P&L, a test cash flow, a test balance sheet? Do they have, and if they're raising $1 million, do they focus on their use of proceeds and what's in the use of proceeds that they're going through? So, and oh, by the way, on the financial side, my goodness, if you're a startup and you get ready to be asked for your personal financial statements, right? And so, what we do a lot of, because we will enter into a non-disclosure agreement, is because you're such a young company and you're the founder, we're going to ask you for your tax returns
Mm,
and such, right? We're going to go out and say, okay, we're going to go out into public domain records and see if there's been bankruptcies in the past, right? So we're going to want not only those test financial statements if you're a pre-seed company, pre-revenue, we're also going to want those personal financial statements. And then as you move forward and you start to sell product and service, we're going to want those actuals, right? And we're going to start to want to work through those with you.
yeah. Are there things as you're kind of looking through those financials, are there things that maybe jump out at you that could be like a red flag or things where you're like, ooh, I like how they're thinking about this, how this company has really thought through XYZ. Like what gets you like, ooh, I'm listening, friends, and what gets you like, uh-oh.
Yeah, so the uh-oh, and I've already talked it as a red flag, is like they say there's a service obtainable market that's multi-billions of dollars. They're pre-seed and they're going to capture 30% of it. And then they show us revenue projections are associated with that. At that point in time, we have to have a tough conversation with them. We may
Mm,
like the founder, right? The founder may be great. She may be
right.
fabulous. But then you look at that and go, hey, you're not realistic. So we're going to have a course correction if you're willing to work with us on that course correction.
Mm,
Um, I tend to be more conservative, and so I like when somebody comes through and it's a realistic, it passes the realistic sniff test for me, right? To sit
hmm
there and say, hey, you've done your homework, you've gone out, you've looked at other companies that are similar to you, you're modeling your financials based on real world data. You're not just making stuff up and throwing it and seeing if it sticks. So the companies that are good also have somebody that is, if the founder is not financially savvy,
hmm
they have somebody riding shotgun with them to help them develop that, right? An outsourced fractional CFO or a good accountancy. So
Yeah, I mean, you can't do everything I mean, you can
for
try, but you
for for
definitely.
real, for real. And I'm telling you, we're investing in the future, right? And so we know that the reasonableness test is what gets us through. And if it doesn't look reasonable, we don't invest. If it looks reasonable, we're willing to work with you because once we place that money in, we're your biggest fan. And now we want to see your company grow. And you want that, especially early stage folks, that to be smart money so people can lean in. You just don't want money.
Hmm.
Real quickly, I had a conversation with a client where they had somebody who come in and said, we'll take your entire Series A round. Right. And we went, okay. And it was a family office.
Hmm.
And the family office was nowhere near the market they were in. It would have just been money. Right.
Hmm.
And so what we did was we took a time out and we said, hey, it's probably better if we went and got a lead on this round that was within your space, that was strategic. And then we worked with the family office to bring them in. Because what you want with your funders is not only the money, but you want their network, their willingness to lean in, the strategy and development they can provide, right? The network that they can open up for you. So I think that's very important.
Yeah, I think you raise a good point because I think sometimes there's a little bit of a fear like, well, I want to have, power of the direction of my company. I want to be able to like have the say so. And if I get too many like people whispering in my ear, I'm not sure, like it's too much and I want to be able to have control of my company. But at the end of the day, these are people that are experienced and want to see you succeed, right?
Yeah, and it's true. Early on, I mean, we see cap tables all the time from pre-seed and seed companies that have like 50, 100 people in it. And it's because they were willing to write small checks. And so what we tell folks is if you could find an aggregator in some way, shape, or form, like I'm not advocating for them, but like one of them is like a start engine or some type of platform like that where you aggregate that so it shows up that you don't have 50 to 100 people with $1,000 checks on your cap table, that it's all sort of consolidated, or you're able to work with somebody to put together a special purpose vehicle, which is a structure that
Mhm.
allows all these people to come in with their smaller monies, but it's into a singular entity that it invests, right? And then I would say one of our biggest pet peeves and red flags is when somebody does a pre-seed, even seed round, that's equity. So think about it this way, right? So who do you go to first? It's friends, family, founders, and fools is the joke I use, right? And so that's the early money that comes in, and then they're putting money in, and all of a sudden, mom and dad put 200 grand into the company. They own 10% of the company and a pre-seed value, pre-seed, which means now the company's valued at $2 million. And I come in and I'm like, wow, you don't even have a minimally viable product yet. You're not
Mm.
worth $2 million. You're maybe worth $1 million. That's a very awkward conversation to have with mom and dad around the holidays. You want to go to Thanksgiving, right? Maybe you celebrate, if you don't celebrate Thanksgiving, you want to be able to sit around the table. And then that 200 grand that mom and dad put in because now you're negotiating with me or a similar firm is now only worth 100 grand because we only value the company at 1 million, right? So what I tell everybody is, and this is again a red flag, if it's equity early on, there's a lot of restructuring work we have to do, which creates deal friction, which gets us out of the way. What we say is we prefer convertible notes for early on, right? Debt that in the future converts to equity. There's this other thing out there called a SAFE, a simple agreement for future equity, that I think, I'm not a fan of,
Mhm.
but it's widely used. These are two tools that are essentially a way to kick the valuation can down the curb and get money into the company to get you moving forward.
I love that. That's great advice. Okay, so we've kind of talked a little bit in the financial realm. Let's talk about kind of those legal things that you want to make sure you're covering in the data room or just kind of have available. What are things that like you want to make sure you see in that
Yeah,
space?
I want to see the incorporation documents, the operating agreements. I want to see any contracts that they may or may not have in place, both contracts for revenue and contracts for services. I want to see the cap table and how the ownership's going to work. If they're in healthcare, and they're in digital, there's going to be SOC 1, SOC 2, high trust, all these different security, requirements that are required. HIPAA, right? Business associate, a BAA, a business associate agreement. I want to see that they have all of these different documents and structures put in place. We generally don't, well, we don't invest in LLCs, right?
Mhm.
We tend to want to invest in C Corps. And then, we've worked with companies that are an LLC that we're going to invest in that they're moving to a C Corp. So we're willing to come in at that point in time and help them out. Um, So yeah, we're gonna want, and then intellectual property. I don't know how many people, how many times I've seen folks trip over intellectual property. And and my favorite is, hey, I've designed this product with this doctor. Well, who's the doctor work for themselves? Does the doctor work
Mhm.
for a university? Are they employed by a hospital system? And inevitably, in these days and age, it's employed by a hospital system. Very few physicians are on their own. It's a declining group of folks, and now they're with a hospital, and they've now co-created this company with you. They're employed by the hospital. There's a good chance now that that employment agreement has an intellectual property, right? So you have to have that intellectual property high and tight and understand who owns what and how, right? And then, of course, you go through all the, did you file a patent? Did you file what the type of patent? Oh, I am far from an expert. I lean into other folks who are, right? When we
Mhm.
go into the intellectual property side of the house, I know enough to be dangerous, but man, you have to have your IP high and tight if you've got any of those type of relationships, because it's never more embarrassing when you realize that you don't own your company because you don't own your IP, and that happens more often than not.
Yikes, that's got to be
Yeah, it's not a
a
fun
rough
conversation.
situation. Yeah. And you're right, we do see that. And it's not that you can't disentangle that IP from another organization if it's tied to it, but you need to be going through those agreements and everything. And it's another reminder why like these founders agreements and these initial agreements are so important, because, otherwise you got kind of flying without a net a little bit.
Yeah, yeah, no, um, and 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 I hate to say this, but sometimes the early money comes in and they're not smart enough to know what that is. So all of a sudden now I'm going to come back to mom and dad, or like sitting outside looking in going, well, what happened to my 200 grand? Oh, by the way, it was used to develop this IP now, which is partly owned by a large hospital system or a
Right.
university. And we have to have this agreement in place. And oh, it's just, you got to do this up front, right? High and tight.
Yes, it definitely can come back to bite you, no doubt. What about the team? As you kind of are looking at an early stage company and thinking about the team, what are things that you would like to see in place? What are the things that you think are important? And what, again, are those like red flags that kind of pop up and you're like, oh,
Yeah. And so, we evaluate the team 100%. So if you're coming into us and you have a CTO, a CEO, a CTO, a chief administrative officer, COO, a CIO, like whatever the C's are, right? All the C-suite, right? As we would say, we're going to do due diligence on them. We're going to want to know who they are, what their background is, what they're bringing to the table. We're going to want to know if they're employed, if they're contract, if their employment agreement is, if it's based on cash and equity, or what kind of options are they getting, what are they pulling from in the pool, right? We're really going to need to understand how they all work together. I remember we were in a meeting, we were doing some due diligence on a company on behalf of a client, and the entire C-suite was sitting around the table and they started arguing with each other
whoops,
about the question we asked because they didn't think that the one person answered it correctly. And the meeting did not last very much longer after that.
yikes.
So and I say that not ugly, right? I say
Right.
that
No, I
just,
mean, yeah,
you,
just
you
kind of
know,
rail.
and you're starting a company with these folks, especially if they're all part of the founders group. And these are relationships that have to be solid and tight. Otherwise, the company doesn't succeed and people won't invest. You also want to know exactly the skill sets they're bringing, and if there are any skill sets missing, where can you lead in? And respectfully, I think you know this. We act as fractionals sometimes. We come in, and when somebody needs mostly it's a fractional CAO or a fractional chief growth or revenue officer is the
Hmm.
way we behave, right? And the joke is for the younger companies is like, for the folks like no hair, gray hair, it's the adult in the room is the joke I'll use, right? That we're brought in because we just have that experience, and lean in on that.
Yeah.
Lean in on that, and lean in on fractionals because they can get you the resources you need, but you don't have to go out and carry um, the weight of the salary that's necessarily if you wanted to get that person.
Yeah, I know we talk a lot about fractional C-suite positions. What about advisors? I mean, especially during this early stage, we see a lot of companies that have really strong advisors backing them, whether that's on the science side, on the sales and distribution side. How much weight is put into things like that? Is it more of a it can't hurt or it could hurt or, I
Well, if you remember, we had a startup prize company go through that process, and they had an advisor who ended up losing their physician's license. And so that was a hurt, right? And there was some conversation in the room that he was known to push the envelope a little bit. So what I'm going to say is, if you're going to put an advisory board together, make sure that they're more than um, resume building advisory board members, right? That just want to put that like and sit there and say, I'm an advisor of, make sure they're actually adding value. And if you're going to put them forth in your due diligence, which is what we're talking about today,
Mhm.
know that they are going to go through the due diligence process, right? So if they're an advisor, they're going to get a phone call, right? We're going to find out who they are and what they're doing and how many hours they're committing to this and have they invested themselves? And we're going to ask all these questions. So I would sit there and say, if you're going to put an advisory board together, construct it carefully and make sure they're adding value.
I like that. Okay, let's kind of look at a couple more ideas, kind of in this whole sphere. What about your market? I mean, we talked about like a total addressable market, things like that. What are you looking for as people kind of are addressing the problem and how they're thinking about it and their market?
So again, I come back to a realistic sniff test. Like if you sit there and say it's a $10 billion market and that, right, that's the total addressable market. And then the service addressable market is 5 billion. And then you're going to have of that, you're going to have a $2.5 billion service obtainable market of which you're going to gain 33% in 3 years. I'm going to look at you and laugh respectfully, not in your face or at you or be ugly. It's just going to be like, no, that's really not going to happen. Bless your heart. Right.
Right.
And so we want to know that they've done it, that they've gone and done their homework on compounded annual growth rates. So they know their cager, they know what their marketplace is looking like over the next 7 to 10 years, 5 to 7 years, maybe if you're digital software, right? If your product or service, excuse me, let's do this way. If
Okay.
you're digital, I would say 5 to 7. If your device, you're 7 to 10. And if you're a therapeutic or a cell, it's 10 plus, right? Is the way you look at it, right? And the way we look at it, right?
Mhm.
And that's why we don't invest in devices necessarily or therapeutics because our checks are so small and it takes so much money to get them to the marketplace,
Mhm.
right? And so that's the why we are the confluence of what we are. Although there are some really good, I would sit there and say companies that are devices that have gone through a process where we know we can step in and be immediately of service, and we know they're sort of towards the end of that like runway. They just need that little oomph to get them over, right? That's when we'll come
Sure.
in more than likely as a fractional of some sort, not
Sure.
necessarily as an investor, but we'll come in and we'll provide services. And I'm sorry, this is not meant to be a commercial for sure.
Sorry.
We're very much looking for realisticness in the TAM SAM SOM. We're looking for the realisticness of they've done their homework on, they know what their compounded annual growth rates are. We know what the competitors are. We know how the competitors are working, right? We're going to look at all of that to sit there and say, okay, yes, this is something
Mhm.
that's realistic and we can move forward.
Okay, and then lastly, maybe thinking about operations, kind of in the maybe not like C-suite side of things, but more in just like day to day, your vendors, maybe your supply chain or where you are in your development process.
Yes, we're gonna
Sorry,
we're
I
gonna
didn't
get.
really ask a question there.
No. That was a
Expound,
question.
expound.
I would sit there and say that we're going to look at those supply chain. We're going to look at your supply chain. And we're going to ask who your vendors are, and we're going to ask what those contracts look like with your vendors, right? And this going to be part of the due diligence. We're going to want to make sure that there isn't a singular point of failure. You know, if you're a product company and you've got a handful of suppliers and one of them makes a critical part and there's no backup to that supplier, that critical part, that is a single point of failure. Um, this is not a political statement. During COVID, the supply chain went to hell in a handbasket,
Oh yeah.
right? It just absolutely disappeared because people were not shipping anything anymore. And all of a sudden, stuff like PPE disappeared. And now we're in an environment where the supply chain is being disrupted due to different tariffs that are being levied on various different, and sometimes the tariff exists and sometimes the tariff doesn't. And so what we're seeing when we're working with these startup companies who are needing a part of that from the supply chain is that it becomes part of the risk of investing. we have to understand what that risk is, and we have to know that the supply chain is not very stable at this point. Or if it is stable, we now know that there's an additional cost factor associated with it. And now, can you go to market on that additional cost factor? Right?
Mm.
I mean, it's the added expense, and suddenly your product, which maybe you were selling at, $100, is now $120. Well, did you just priced out of your marketplace because now you're in with a group of competitors that were, slightly lower, a little bit. I mean, it's so what we look at it is it adds risk, right?
Hmm.
And our risk appetite is, in specifically this instance, not as risky as if it were a digital company, which is really dependent upon the brain power of the people who are putting together the software. And then even then, right, we would ask, well, where is the folks doing it? Are you doing it near shore? Are you doing it onshore? If it's near shore, where? If it's offshore, where? Right? How are you protecting that software? Is it entered into a repository? Do you have it in escrow? Right? So we're going to ask all these fun, difficult questions sometimes.
Okay, I feel like we've kind of covered what's in that data room. Is there anything that you feel we've missed? Or,
No, I
and I
mean,
will tell,
just very good.
oh, I'm sorry. I was going to say too, I will tell anyone who is watching live with us right now, if you have any questions, like please drop them in the chat. There'll definitely be some room at the end for questions as well. But if there's moments where you just want a little bit of clarity, just drop it in and we'll throw it out there. Um, sorry. Yes.
No
Okay.
worries.
But yeah, so okay, data room, we've kind of covered those types of documents, the type of information you're looking to see, where folks maybe sometimes get tripped up and kind of have those problems. You know, maybe we kind of look at, I know we've kind of delved a little, but just in general, those common mistakes with early stage founders when it comes to due diligence. I know we talk a lot about it. When it comes to like that going in the room for the finals, right? And you're
Mhm.
giving your final presentation. Uh, we often talk about, especially with these earlier stage companies, sometimes what you're presenting is science and not necessarily a business. And I wonder, because you've been in the room, you've seen the
Yeah.
companies, and I'm sure this is not unique to Startup Prize, but I wonder if you could speak a little bit to early stage founders as they're honing their pitches, as they're getting more and more comfortable with their businesses, how to make sure they are presenting a business and not just the science.
Yeah. So our favorite is are you a science project or are you a business? Right? If you're a science project, help me understand how you're becoming a business. Right? That's what I want. I want you to be able to sit there and say, okay, yes, our platform is. I'm gonna just like I'm just recalling this year micro bubbles that get across the blood-brain barrier for this particular drug or this particular area. Okay, great. That sounds like a phenomenal science project that needs a lot of non-dilutive funding to get across the line. Great. Now, what does the product service set look like that around it? Because now, if you're going from point A to saying, and here's the 10 other products that come along with that, and here's the undergirding service, now you're heading towards a business. And so if
Mhm.
you're coming in and you're coming in hot as a science project, just help us understand when you're going to become a business because we're not going to fund you. We're not in the, at least I'm not, I would say, in the business of funding science projects. I look towards universities, non-dilutive funding like small business innovation research grants, the small technology transfer research grants that are out there with universities. There are state like, I know Louisiana and Texas and South Carolina where I live all have state non-dilutive funding for those types of things to get you over the line. When you come to us and you're raising money for your company, you best be a business. Um, so yeah, I mean, and then the other red flag is not knowing us as a funder. I don't know how many times we're approached by somebody who's like, and we really like you. I'm like, we don't even fund that. Like, did you go to our
Mhm.
website and see that our thesis is X? No, next. Like you're just that's an immediate no. So don't give people like don't give funders a reason to just say no out of the box. It's easy. No is easy. Yes is hard. I talked about equity too soon, big red flag. I've talked about not doing your homework, and I've talked about like the over exuberance on the market size. All of those to me are just giant red flags. The other thing I would say, especially when you're an early stage company, you should be confident as the founder of the company, but not arrogant. And you must be coachable. And so we're really going to evaluate the coachability of that person because inevitably there will be hiccups, bumps, burps, right? And you're
Hmm.
going to want these folks on your side. We're going to want to know that that person is coachable and will
Yeah,
be willing to
speak to
listen.
me. While we're kind of in this area, maybe a little bit of that kind of investor-founder relationship. And I realize that, everyone is different in how they approach it. But kind of, I think I have a sense of where you fall as we've talked through talked through today. But maybe kind of what, like in an ideal world, like your perfect founder and investor relationship would look like.
So it's an understanding that it is a relationship. It's not transactional, right? We've come in as early as we have because we believe in you, the founder, and what you're trying to solve and the problem and your why. And you've put together a solid, you know, structure to create this company and move this company forward. And then what we require are regular periodic meetings. So I have some founders that are like early on, they're like, I want to meet weekly. I'm like, great, 30-minute meeting model. Let's get that done. I have some that is biweekly, I have some that is monthly. And
Mhm.
then as the relationship develops, we move it from like a very high touch to a, more like let's check in or, they all have my cell phone, right? Like
Mhm.
they call me when, if there's an emergency. I mean, I joke around. I've had a couple of founders call me crying, like literally in
I can
tears.
believe
And oh,
that.
by the way, let me say this, men and women alike, let me just say this, right?
Mhm.
It's equal. I would say it's about a 50-50 at this point in time right now, where, and you have the conversation. And this is going to sound terrible, but sometimes we act like counselors.
No,
It really
I don't
is.
think that's like, I think that's totally understandable. First of all, like, especially at this stage, we talk about it all the time, it can be incredibly lonely. I mean, like, you're tiny teams, you're taking on a lot. So, like, yeah, I could see you absolutely taking on that role. I mean, like, you're advising already. So, like, it's not that far
So
of a step
I had one
over, right?
founder that we knew every Wednesday afternoon that she would have a glass of wine in her hand and I would have a bourbon. And we would be talking about what was going on and you talk about the ugly and the
Hmm.
great and the hope and the loss, right? It is. And we're investing in you because we're in it for the long haul. We want you to be successful. And oh, by the way, by doing well, right, in business, we can also do good in the world, right? And
Yeah.
so I want you to do well so we both can go do good.
Yes. No, I love that. I have one more question, and then I'm going to open it up for folks. So as we're kind of, because I know we see companies that are kind of getting further along, right? Kind of hitting that Series A. As you start to leave this earlier stage, what are some other things, maybe as you're advancing, as you're starting to hit that Series A level, maybe some things that should be in the back of your mind that you should be focusing on, thinking about, as you're kind of moving forward?
So Series A has changed over the last 5 years.
How would
Series
you?
A used to be meaning Series A meant that you weren't cash flow positive or you didn't have a line of sight into a positive EBITDA. And it was still you've got product market fit, right? Your MVP is no longer an MVP, it's MVP-ish. It's not that way anymore. Your Series A is a growth round going forward, period. They
Mhm.
expect pre-seed and seed to get you get your and non-dilutive to get your act sorted out. And everyone we're seeing and everyone we're helping with their Series A are heading towards or either cash flow positive and in a line of sight in a positive EBITDA by the end of this year. So we've got 2 or 3 companies that are going Series A right now. They will be cash flow positive by the end of this year. They will have a positive EBITDA, and they're going to market because now they want to grow more quickly. It's more gas in the tank to grow even more quickly. I mean, we have one client that has nailed now after 2 or 3 years product market fit. And we know this because they'll end this year with a $2 million net, not gross, net
Uh-huh.
revenue
Yes.
on a recurring revenue model. And they have contractual obligations with line of sight into 15 million next year,
Wow. Wow.
right?
That's
And
amazing. Yeah.
they're going through a Series A
Uh-huh.
to go to
Serious.
market to fund that growth, right? And
Wow.
what that means for an investor is that
Mhm.
your risk is greatly reduced. Your company's got product market fit. You've got contracts with people who are buying, right? And now you're coming in, and the temperature in the room gets taken down.
Mhm. I
So
love that. And we have some folks that are throwing, oh, Kathy Wyatt. Gosh, great to see your name up there, Kathy. It's been a while. Good to see you. What type of exit expectations what type of exit expectations where angels get their money and more returned are realistic to propose?
okay,
Okay, yeah,
so you ready? So
great.
this is called the rule of 10, and it goes 4, 3, 2, 1. Okay, 4 go toes up. We know that's going to happen, right? 3 break even. 2 go in that 3 to 5x, and you get the one that's in the 10 to 15x, right? And so we're always trying to invest in those groups of 10. And so right now for me, my multiple on invested capital has to be between 3 and 3.5x the money I put in, and we ideally like it to be within 3 to 5, no more than 5 to 7. So our IRR is still, internal rate of return is still reasonable.
So, as a founder, how are you being able to maybe discuss or describe these returns in a realistic way?
Yeah, if you come to me and sit there and say, "Hey, Cian, invest 10 grand and it'll turn into 100 grand in 24 months," I'll be like, "What are you selling?"
And call me, call
I'm
me.
like, wow, okay. Is this like, did you just get a pass on? I was talking to a friend of mine today, and it turns out that in North Carolina, you can sell under the liquor law THC infused products. It's under a malted beverage, right?
Uh-huh.
I'm like,
Yep.
maybe that. I don't know. Like, I'm
Yeah.
like, come on, y'all. Like, so, and again, y'all, I hope everybody understands. I try to teach and be funny or like not so serious. The seriousness comes in that I am going to work with you to achieve. Once I invest, I want to work with you to achieve those returns. And I know out of the 10, there will be 4 that'll go toes up, and it's just like it is what it is. I can't help it, right? And no matter how hard you work, maybe the market moves. Maybe there's something in the market that changes that, like, I don't know, regulatorily takes you out of the marketplace because you can't do it anymore. There's all kinds of things out there. And then you know what you know what you don't know, and then you don't know what you don't know. And the don't know what you don't know is what keeps you up at night that you're trying to figure.
Mhm.
You're trying to, okay. So Kathy, I would sit there and say for mine and that blend, it's 3 to 3.5x. Right now we're just in the middle. We're at like 3.23 or something like that, right? So far so good. And we have a couple of exits coming up. And so for us in a family office, let's even talk about this. We meet you, we like you, we bring you in for the first interview. Now we're going to move to diligence. We've moved from diligence to a negotiation of the investment. We've now invested, and usually early on for us, that's a convertible note. Very rarely is it equity. Sometimes it's a safe. Right. Anyway, but
Yeah.
now we're in there, and we're working with you to get that, that to where it needs to go, I guess is the best way to say it.
Yeah, no,
So
it makes a lot of sense. I mean, like at the end of the day, you are not only are you investing, you are invested. I mean,
yeah, and where I was going with that is that then as a family office, when we place those bets,
mhm,
what's great is you get those returns. And so now say you invest 50 grand and it comes back as 5x, is 250 grand. What a family office does and what we do is a portion of that gets taken as income. Let's just be honest with you.
mhm,
Right. And then a portion of that is used to operate the organization through Robinson Ventures. And then a portion of that's redeployed.
yeah.
Right. And so unless we're seeing exits, it's really hard to deploy capital. And that's what's been going on out in the marketplace. Capital is really hard to come by these days because
Mhm.
there are not as many exits as there used to be.
Interesting.
right? We're starting to see it creep up a little bit.
Yeah.
There's not as many acquisitions. That's an exit. There's not as very few, but IPOs, mostly exits or acquisitions. Just saying,
Mhm.
right? So it's still a tough market out there.
Yeah. Well, yeah, I know. I know.
I mean, if I could park 100 grand in a like it's something at 7 or 8%, right? It's easy
For
money.
sure.
It's seven
Yeah.
or 8 grand that just shows up
Right.
right, without doing anything, or as opposed to deploying 100 grand and then I'm hoping that they're not one of the four.
Right. Yeah.
So if I can I follow up just real quickly?
Oh, sure. Is that
So
Kathy? I hear your voice.
yes, yeah. Hey, Melissa, great to see
Hi.
you. So what I thank you very much. That was great information. But the second part of my question was if um, if we're trying to present this as part of our kind of data room that we're building for you, is it mostly based on those financial projections showing that we have that capability or capacity or that's expected in 3 to 5 years? Or are we trying to go out and find something? Do we need to bring in kind of whatever we can find about comparable exits or something that we think might be appropriate analogies for us? And just how do we document, verify that? Is it just financials or do we look for other items also?
No, so that's a yes and is what you said. So I want you to just demonstrate to me that yes, you know where you're skating to and you know you're going to exit. You're not going to tell me you're going to go IPO in 3 years, that reasonably you're going to be acquired, right? And so there's that reasonableness test, right? So you're modeling that out for me. The most powerful thing is if you have a predicate company that you can compare yourself to show that there is a realistic expectation and there is a probability that you will exit because similar companies exited in it could be your specific market and it could be core adjacent or tangential markets. If you don't think you completely have a same situation. Um, and then the other red flag M is when somebody says, "Oh, we have no competitors."
Oh my
There
gosh. I
is
was
nobody else
wondering if
out
that
there
was
in the
ever going to
marketplace
come
like
out.
this.
No
You're like, "Oh,
competitors,
whatever.
none at
Okay,
all.
bye." Right. Kathy, did that get you to where you need to be?
That's great information. Thank you for sharing it. Real helpful.
All right. Well, I think we are coming up on our hour. So, uh, I will, unless I have any other questions, I'm going to end it on this one. So, your one piece of advice to early stage founder preparing for due diligence, what are you
It's
telling them?
it's not like a singular, it's like an amalgamation of
Give us
what
an
does.
amalgamation.
So first, evaluate your investors as deeply as they evaluate you. You want to make sure that there's a fit, right? You want to make sure that there's otherwise it can be hellacious, right? It can be
Yeah.
with unrealistic expectations. Um, be confident and not arrogant. Be coachable. Diligence is a negotiation, so frustration with the diligence process, right? It's never good to show. Um, be careful of some of those who conduct diligence for their own knowledge to go do their own thing. And then finally, understand what no means. Okay. You're gonna hear even through a diligence process, you're gonna hear no more often than you say yes. You hear yes. Understanding the no is equally important because it doesn't mean no forever. It means no for now, right?
Hmm.
And some of my favorite investments are folks that I said no to first, and then they came back around to, and they said yeah, and then we said yes. And then not only did we say yes, but we had other folks that wanted to line up around us with the yes, right?
I love that. And that is not an unusual thing. I hear about that, from more than just you. I'm wondering, just give people like, if you want to kind of stay in touch, maybe like an investor told you no, but you really do think that down the line there is potential there. Maybe you're just not ready yet. What's the best way to kind of stay in touch, so to speak? Like without like being like, oh,
Yeah,
want to
nudge.
kind of like
No.
not in your face, but like just kind of like you just want to kind of stay a little top of mind, maybe side of mind.
Yeah. So I love being put into the investor emails that they send out. So the investor update emails, even though I'm not an investor, you send it out to me so I can see your progress. And then I start thinking, go to the conferences that your investors go to, and serendipitously bump into them
I love that.
while they're at the conference, and say hi and be nice. You don't have to buy us a drink or a cup of coffee. We just have to be able to have a chat. And then don't be afraid to pick up the phone or hit them up on LinkedIn or some way say, hey, you got 15 minutes for me in a few months, right? So I would sit there and say, if you start calling me every week, I'm going to be like, okay, no, and then I'm going to block.
Hmm. Right.
um, but if you're gonna be professionally and politely persistent,
Hmm.
I'm good, right? So
Like that.
emails and an occasional text or call, bump into me, say hi on LinkedIn. Great.
I love that. Well, and it's a really low key way to just kind of not be lost in the shuffle,
Yeah. Be
and maybe
relevant.
it's not the right
Yeah, be
fit for
relevant.
you, but like also I've also heard where it's like I don't invest in that type of thing, but you need to be speaking with so and so over here, you know?
Look, we had a company that they didn't win, but they went through the process. And normally I don't invest in that stuff. And
Hmm.
somebody else in the room did. And I'm like, okay, I want to know the why behind that. And then I
Yeah.
did. It's an outlier for me. It's like I never invest in stuff like this. And they
Hmm.
got me to yes.
Yeah.
Now it's not a big yes. It's a small yes. It's
Right.
the minimum yes, right? That
Got it.
got me into the round. But I
Hmm.
said yes.
It's a yes. Well, I love it. Well, Cian, thank you again, like for
Of
giving the
course.
time today. We really appreciate it. And for all of you who like came and hung out today with us, love that you're showing up. I love seeing like the familiar names and I love seeing some new names in the mix too. So again, we do these monthly, come hang out, say hello, and we're gonna go ahead and end it for today. Maybe a little Viva la Startup Prize, Cian.
Oh, Viva la Startup Prize for sure.
Heyo. I love it. And for those of you who are with us live, I'll stick around for a little bit if you want to say hey and tell us what's going on. And otherwise, we will see you next time, everybody. Thanks again for hanging out.